The XRP ledger processes every transaction sent to the network, maintaining low fees during high activity. For throughput and latency, the L1 comprises solved variables. However, high-speed cryptographic finality provides little utility to institutional players if they cannot move large-scale value without causing massive price slippage. Deep, non-fragmented liquidity is the specific architectural bottleneck currently holding back widespread network adoption. Solving this requires a dual-layered approach. At the base protocol level, the network must utilize native automated market makers, or XLS30, to aggregate liquidity and capture arbitrage yields. This L1 optimization only functions if there is a bridge to traditional finance. Trillion-dollar treasuries require SWIFT-certified APIs and investment-grade counterparties to interface with these digital assets. The network is currently integrating these layers, transforming from a retail-focused ledger into a professional financial settlement engine. The XLS30 protocol update introduced native automated market makers that operate continuously alongside the ledger's central limit order book. The ledger automatically routes swaps between the order book and AMM pools, ensuring the best price. A continuous auction mechanism captures arbitrage revenue, looping it back to liquidity providers. This offsets impermanent loss and stabilizes yield. Because this is a protocol-level execution, it removes the vulnerabilities associated with external smart contracts. Many high-profile exploits, such as the $280 million drain on Solana's Drift protocol, occurred because of compromised admin keys within these external layers. During that specific exploit, stablecoin issuers like Circle were unable to react in time to freeze the stolen funds as they were bridged across chains. This lack of response during peak trading hours drew heavy criticism toward industry leaders for their inability to secure the assets under their control. The XRPL architecture provides market makers a different proposition: yield generated through protocol-level security, consistently low network fees, and protection from front-running. A secure protocol is only one requirement. Treasury departments cannot interact with digital infrastructure without a legally vetted, investment-grade counterparty. To meet this requirement, Ripple Prime secured an official BBB issuer rating from the global credit agency KBRA. A BBB rating classifies an entity as investment-grade, placing it in the same risk category as traditional banks and brokerage firms. This classification distinguishes Ripple Prime from speculative crypto startups, providing the validation necessary for institutional engagement. KBRA based this rating on Ripple Prime's business model of matched principal risk control. Unlike a proprietary trading shop, a matched principal broker acts as a neutral clearinghouse, avoiding directional bets that could jeopardize the balance sheet. This TradFi validation clears the path for corporate treasuries to deploy capital onto the ledger through a trusted intermediary. While the AMM provides the technical engine, the investment-grade counterparty provides the regulatory access point required for treasury-scale liquidity. The final layer is the software interface. Ripple addressed this through the acquisition of G-Treasury, a provider of corporate treasury software. G-Treasury is a SWIFT-certified provider, supporting standard messaging formats like MT and ISO. This acquisition gives Ripple infrastructure-level access to the SWIFT network, allowing them to integrate blockchain settlement into software that banks already use. G-Treasury's API integration with banks like PNC demonstrates how this data bridge functions in practice. Traditional treasury workflows rely on end-of-day batch processing, which creates significant data lags when making liquidity decisions. Replacing these batches with a direct API connection provides real-time visibility into cash positions across all banking accounts. The system natively leverages existing reporting formats like BAI2 and CAMT, meaning finance teams do not have to rebuild their IT infrastructure. This visibility allows for outbound payments to be executed and audited instantly, 24/7, through a single dashboard. Connecting these legacy systems to the ledger shifts the role of corporate finance from reactive bookkeeping to real-time liquidity management. This flowchart demonstrates how a single liquidity request traverses the unified stack. It begins with a corporate finance team initiating a cross-border payment request through their existing treasury interface. That request is instantly cleared and underwritten by the investment-grade counterparty infrastructure. Finally, the trade is executed natively on the XRP ledger, routing through the AMM and order book for the best available price. The combination of API rails and investment-grade status removes the software and risk barriers that have historically prevented traditional finance from utilizing digital ledgers. The technical components required for continuous global clearing, including the base protocol, the counterparty, and the software, are now fully linked. The final catalyst for utility is the depth of the liquidity pools themselves. The architecture is complete. The success of the network now depends on incentivizing institutional market makers to deploy capital into this end-to-end settlement engine.